Hey, everybody, and welcome back to the Teaching Tax Flow podcast, episode 132 today. We are diving into the Retirement Savings Contributions Credit. Better yet, it's known as a Saver's Credit. And before we get into this one in detail and figure out if you qualify or somebody you know does, let's take a brief moment and thank our episode sponsor.
This podcast is brought to you by Legacy Lock. If you are new to estate planning or simply need to review your current plan, Legacy Lock makes it as easy as pie. Legacy Lock is a unique platform that enables you to easily complete your attorney-drafted documents conveniently from the comfort of your home or office. Your first step to this peace of mind is simply visiting teachingtaxflow.com/legacy.
Hey, everybody, welcome back to the podcast today. We are going to dive into, as you've seen in the show title description there, we're going to look at Retirement Savers Credit. So I have no idea actually what this is, Chris. So I brought my pen. I got my paper. Let's hear all about this here. I'm intrigued, sir.
Well, you didn't welcome me back to my own podcast this time, but I'm going to welcome myself back in. Thank you so much for the warm introduction.
You know what it's like? It's almost like if I was standing in the front door of your own house inside and you came to walk into it and grab the handle and I opened it up and I was in there. It's like, oh, well, welcome home, sir. Welcome home.
Well, first of all, before we jump into this topic, I truly appreciate, we have seen a ton of growth in our YouTube channel, Teaching Tax Flow YouTube channel, and our Defeating Taxes private Facebook group. That's defeatingtaxes.com or www.defeatingtaxes.com. This isn't the sexiest topic we talk about here on tax planning and strategy, but the feedback from everyone has been so kind, so encouraging, and actually, our topic ideas come from you, the listeners, the viewers. So thank you so much. We truly appreciate it. We do not take you for granted. If you are listening on any of the major, Spotify, iTunes, et cetera, just, take 2 seconds, give us a like, or jump, if you really want to be our friend, jump over to our YouTube channel. The link's going to be in this podcast, and all you have to do is hit subscribe. The cool thing is we don't give you a bunch of fluff and junk. We give you some really good content. And honestly, we love doing this. This is complimentary content. This is 20 plus years of being in the trenches as a CPA that you're getting delivered to your device. And, quite frankly, that's the least you could do is say, thank you. Good job. We appreciate you. Okay. I'm off my soapbox, John. I'm coming in a little terse, huh?
Hey, it's all good, man. It's all good. You're right. I mean, just the audience and the communities that we have at these events, on these online communities, it's great hearing what people are interested in. And obviously we have the downloads to prove it, that people love this stuff.
For sure. So let's talk about the Retirement Savers Contribution Credit. It's a federal tax credit out there available to all taxpayers. If you meet the qualifications, we're going to talk about the qualifications. You might find this online as called the quote unquote Savers Credit. And before we jump into the details, I want you to remember one of the 3 laws of teaching tax flow, that tax agencies are your involuntary business partner. Tax laws are written to what? Encourage or discourage behavior. That could be financial, that could be social. This happens to be a financial action that they're encouraging. And we know that not enough people in the United States are putting money away into retirement, specifically people in lower to moderate income households. So what the IRS is doing is they're saying, you know what? You might have an employer that matches your retirement plan contributions, or you might not. But guess what? We're going to be a double bonus employer. If you meet the qualifications, we're going to match your retirement savings contributions for you in the form of a credit. That's free money. Credits are not taxable. So this is a really great opportunity for people to take advantage of this credit. Many listeners might already be receiving this credit and might not know it, because sometimes people just look at the bottom line of their tax and do they receive a refund or do they have a balance due? By the way, if you have a balance due, that doesn't necessarily mean you did anything quote unquote wrong. It just means you didn't pay in enough during the year to cover the tax that's due. If you want to change that, If you want to control your tax, you do that by tax planning. Remember, the IRS picks your federal tax unless you take control and you do tax planning and strategy, then you get to pick your tax.
And Chris, you mentioned it's a credit, right? And I think an easy way to kind of get that across to or drive it home, right? It's basically like extra credit. Back in school days, like you have to do something to get that credit. They just don't hand it to you for the heck of it, right? Like you have to, um, I should say, contribute to get the match, right? You're just not going to get it. They're not going to dump money into a retirement account for you. That's not what we're talking about here.
Right, right. Exactly. That is true. You're right. So the credit you get, it's like extra credit. You get credit for doing that. Well, let's jump into the savers credit. Okay. Couple things we have to remember. A credit and a deduction are two different things. I know we have a ton of content in Teaching Tax One on the YouTube channel about that, but a credit is typically better than a deduction. A credit is a dollar figure that benefits you. A deduction is an amount that you reduce your taxable income by. And then your credits come in two different shapes and sizes, right? You've got refundable, you've got non-refundable. Refundable credits are better typically than non-refundable credits, meaning easy for me to say, huh? A refundable credit means that even if you don't have tax, you get that refunded to you. The vast majority of credits are non-refundable, which means you get the credit and it offsets federal tax if you have federal tax to pay. And that could ultimately give you a larger refund. The savers credit is a refund or is a non-refundable tax credit. So it's a federal non-refundable tax credit. And again, it's really there to encourage low to moderate income individuals to save for retirement. Now, let's start with some good news, John. The credit applies to many different qualifying retirement accounts, not just tax deferred accounts, right? So it's traditional IRAs, Roth IRAs. So think about this, John. You could potentially put money into a Roth. You're in a lower to moderate income household. You don't necessarily need that tax deduction today. So you're putting money into that Roth. It's going to grow tax free, which is amazing, and get distributed tax free. And you're going to get a retirement savers credit. That's like the double dip, right? You're getting paid to put money away tax free.
Right.
Wow.
That's
So,
about the equivalent to as good as it gets with the IRS keeping their grubby hands off your dollars.
yeah, it'd be
Nothing
like, hey,
nothing
John, you
against
can
the
have
IRS
this.
completely, but
I know you're not a big sweets guy, John, but I have a sweet tooth. You can have this big scoop of ice cream, and it's going to taste great. You're going to eat it. And when it gets in your body, it's going to burn 2,000 calories for you without doing any exercise. So think about that. So, what retirement accounts are eligible for their savers credit? Traditional IRAs, Roth IRAs, 401ks, 403bs, 457b plans, which is typically for like a school district or nonprofit. And even ABLE accounts are open or are available for those credits. So bottom line is pretty much almost every type of SEPs, I think I mentioned symbols, almost every type of retirement account is eligible for you to get the credit, meaning if you make a contribution. So step one, you have to make a contribution to a retirement account. Pretty much any type of retirement account is eligible. And bingo, bango, as a famous Detroit Red Wings commentator used to say when I think you know who I'm talking about. Was it Mickey Redmond who said
I
that was
think
his?
so. I was
Yeah.
just jogging my memory. I'm like, I believe it was Redmond.
I don't
Bingo
know why I
bango.
remember just hearing that. Anyway, you're eligible for the credit even if it's a Roth. Okay, so this sounds great. So far we're doing good. What's the credit looking like? Well, the credit is up to $1,000 for an individual and up to $2,000 for a married filing joint. Now, again, that might not sound like big numbers, but look at for the people that are going to be eligible for that credit, that could be a significant amount of their disposable income. And the bottom line is it's found money, right? You're getting paid to put money in your retirement account. Not too shabby, John. Not too shabby. Now, here's where it gets a little trickier, right? Because the credit is limited based on income. All right. And that driver is going to be one of two things: your adjusted gross income and your filing status. adjusted gross income. We like acronyms, John. You're supposed to make, and maybe you will once you edit this podcast, you're supposed to make a sound effect whenever we use an acronym here into the Teaching Tax Flow podcast.
It's going to be like a toilet flushing or something completely unrelated.
That's fine, as long as we have one. And I'm going to be listening when this podcast goes live. I really hope there is a sound effect, but I'm going to use an acronym called AGI, Adjusted Gross Income. It's a very common acronym in the tax planning and strategy and preparation community. So your AGI and your filing status determine your eligibility for this credit, on top of, did you put money away, right? So if you put money into a qualifying plan, that's step one. And the next step's going to be, do you get to, are you eligible based on income? So let's listen up. For 2025, we're using 2025 numbers. They're adjusted for inflation typically. So if your 2024 returns on extension, the numbers might be just a touch different. But for married filing joint couples, the credit begins to phase out at $46,000 of adjusted gross income. And it's completely phased out at $76,500. So let me take a step back. When we're talking, this gets really confusing for taxpayers because there are credits. Also, we know that you could be refundable or non-refundable, but some credits have what we call a cliff. Some credits have a phase out, right? A cliff means you get the full credit until you go $1 over the limit, and then you fall off the cliff and you get nothing. Hopefully that doesn't happen, physically. Other credits phase out gradually. So you could be eligible for the full credit, but if your income goes up, it's a sliding scale that you get a little bit less of a credit. So in general, married filing joint couple, $76,500 of adjusted gross income or less are going to be eligible for at least a partial credit. Under $46,000 is eligible for the full credit, which could be up to $2,000. So think about that taxpayer. Let's say they have $45,000 of adjusted gross income. Now, when you look at the numbers, the average household income in the United States, it's somewhat in line with the top part of these phase out. This is what I keep saying, is tax planning is for everybody at every income level. It's not just for people with a lot of assets and a lot of income. And I would argue, and you've been around me enough, John, where I keep beating this drum, that it's actually in many ways more important for lower to moderate income families, because that extra $2,000 is a huge, huge deal for them. So married filing joint, let's say you're at $45,000 of adjusted gross income and you've put money into a retirement account, even a Roth, right? I would encourage someone to put money into the Roth at this point. Well, in that case, you could still get that credit because you don't need the deduction at that income level. So those are the phase outs. 2025, 46,000 of AGI, 76,005 for married filing joint. Let's talk about head of household. So head of household is a filing status when you have a qualifying dependent and you are unmarried. The phase out's a little different, all right? That phase out starts occurring at 34,500. So if you're 34,500 of AGI or less, full credit eligible. It starts to phase out, and it completely phases out at about $57,400. That's for 2025. And then single filers or married filing separately. It's interesting though, because 99% of the time it's better for married couples to file jointly. This might be one of those unique situations where it makes sense to file separately. There's a couple unique situations. But those phase outs are a little less. So for a single taxpayer or married filing separate, the phase out begins at $23,000 of adjusted gross income and completely phases out at about $38,000 of adjusted gross income. So again,
And I know we kind of ran through a lot there as far as for the numbers, how and what. Really, really kind of a dumb question, but not really. Say somebody's preparing their own taxes at this point, or they're working with somebody who just happens to do them for them. Maybe it's a family member or something that, they just kind of, we won't call it they push papers, but it's a pretty simple return. So in this case, if they qualify for this, I mean, is this something that's just a line item on a return, or what do they have to do to get this credit if they qualify for it?
right, if they qualify for it, yep, they just file a separate form. I want to say it's a form 8880. Gosh, I hate
Mhm.
to, I
Oh, I
hate,
know, because I know you probably haven't seen too many of these at all. So this is like asking me what I had for breakfast in, 2002.
no, that's all right. No, it
I
isn't.
can
Oh my
remember.
gosh, I just, it is an 8880. So you file a form 8880, put that in the show notes, please. And also I get my name on the board and with a plus, I get extra recess time
Yeah.
because I did my homework.
I'll put you a star on the board, sir. Here you
Yes.
go. You get a star on the board.
A form 8880. You file that with your personal tax return. So that's something that you just file as part of your return. Now, if you're working with a tax professional, um, or yeah, they're going to pick 99% of the time, they're going to pick this up, right? If you're not working with a tax professional, then you've got to make sure that you're putting the numbers in the right spots if you're doing a self-prepared return. When you're looking at W-2, that's why, I mean, when you look at that W-2, it's funny. I just talked to my business partner on our private CPA, my private CPA firm, that you know well, and we were talking. He was actually working on his sister's tax return who changed states midway through the year, and I'm like, man, and she's a teacher, and I'm like, dude, that's why I'm telling you, there is no such thing as an easy tax return. Nothing is easy. If you mess up, let's say you have someone with a W-2 wage of $35,000 and they put money into their traditional IRA that's nowhere on the W-2 and you didn't realize that, you've screwed up a tax return. Or if you have a W-2 with a bunch of numbers in it with employer match and pre-tax HSA and this, that, and other thing, it's so easy to screw up, right? So
And
yeah,
I know we've been at, again, events, conversations, podcasts. We've done it on the Mr. R show, which is a podcast specifically for tax pros. The topic of AI has come up, more often than not within the last year, a ton. And I kind of see this, you mentioned the seemingly simple return, right, is very difficult in some sense because yeah, it doesn't know exactly what you have going on in your head if you haven't projected that into anywhere. Like, oh, I'm going to move in 6 months. Well, a system doesn't know that unless you put it out there somehow. Now, yeah, sure, it can do a look back and do an analysis of some things, and that's helpful, right? But there's never going to be the easy automatic button. There's an easier button, I'd say, but there's no easy button or a done button.
exactly. And you know what? The other thing is, if you're in one of the lower to middle income households, I would encourage you to look up VITA, Volunteer Income Tax Assistance. And in fact, we've been efforting to get someone from that organization on our as a guest. There's some complimentary resources out there, um, that are maybe they're CPAs, enrolled agents, tax professionals that are retired. They still want to help out. They still want to give back, and they're very qualified to help you with this type of credit. So, don't think that you've got, don't be there's someone to help everybody. Let's put it that way. So,
Absolutely.
so
In
let's get back
every
to this credit.
situation.
I'm sorry?
In every situation,
In every
literally.
situation. Absolutely. Let's get back to this credit, right? So the actual percentage of your contributions that qualify for the credit based on those phase outs is either going to be 10% at the low end, 20%, or up to 50%, depending on where your income falls. So let's run through a quick example. Let's say you're single, you're looking to mingle, you've got $20,000 of adjusted gross income, and good job, you put $2,000 in your Roth IRA, right? If it's $20,000 worth of income, you don't need to put money into a traditional IRA. You put $2,000 into a Roth. You know, you could receive up to 50% credit because you're under the threshold for single filers. That's that's a $1,000 reduction of your tax bill. That's real money in your pocket, right? Now, let's keep in mind, as I'm going to reiterate, and I've already discussed, these credits are non-refundable. So it could reduce your tax liability to zero, but you're not going to get a refund beyond that. And these have to be new contributions. Rollover contributions do not count. Now, the final eligibility. There is ultimately, you typically can't be a dependent on someone else's return, but there's going to be three basic eligibility requirements. One, you must be at least 18 years old. Two, you can't be a full-time student during the tax year. And three, you can't be claimed as a dependent on someone else's return. So this credit works great for someone that's just getting into the workforce. They're no longer a student, and they're just getting rolling. As you mentioned, put me on the spot a little. I don't mind. Form 8880 is where you're going to claim that credit. And also you get double dip, right? Because this credit is in addition to the deduction you're getting if you are going pre-tax with the contribution. So think about this. If you put money into a 401k, right? You're getting a deduction for that because it's coming off your income and you're still getting the credit. So you get to double dip. You get that ice cream, but it burns calories once it gets in your body if you're eligible for this retirement savers credit.
And I can think of a lot of situations like that too. You mentioned, that criteria there at the end. I think that is pretty important. You worded it perfect, right? Like they're not looking, and rightfully so, to offer this to somebody who is a dependent, who's in school, because that is just it's a lot piling in and whatnot. But I mean, I see this as being, like you said, somebody that just got out of school, and I'm thinking of our market specifically where I live. I mean, there's a lot of guys that have gone to trade school, have gotten out, by the time they're 20 years old. Um, they're probably not filing as a dependent. I mean, I'm just making an assumption. Probably not filing as a dependent. They are in a position, kind of as a not it's an internship ish, but they're employed. So right there, when they get out of this, they'll be making 100, 150, $200,000 a year, say, in the utility world or anything like that. But at this specific time, right, they might only be making 40, 45, 50. Like what a perfect position to be in, because they're going to get phased out soon when they move on. So take advantage of that little window that they're in.
Or yeah, and think about somebody that, let's say they've had let's look at someone maybe, that worked at a large corporation for many years. And actually I've got one. I mean, let's look at someone that might be a firefighter, right? They started maybe at age 20. At their age 50, which is my age, they're already going to be they're retiring from and um they still have juice, or they want a second career. Maybe they don't, maybe it behooves them to not draw their pension right away. They have some savings. So for the next couple of years, they might not make a ton of money. Maybe they're working part-time as a substitute teacher and they want to spend more time with their kids. They might be eligible for this credit. The point is, for this credit, it's all income-based year to year. There's no asset level test. So you could have $10 million and get this credit if you meet the income criteria.
That is a excellent point. Like, yeah, a lot of guys retire, women retire, and then they go, like if it was up to me, I'd go be a greeter at Lowe's or something like that. And not Walmart. I'm not a Walmart fan. It's a whole nother discussion. But anyways,
We know your feelings on Walmart. Unless in Walmart, if you want to sponsor, we could turn you around.
apps and Buc-ee's. If somebody wants to go work at,
Oh no, I
although
went there yesterday. I don't want to talk about it.
I have to say it because you bring up pickleball all the time. I believe it was a post that was put out by them. They pay a crap ton
They do.
for managers,
And,
but you also have to deal with chaos.
and
Literally
what's
24
interesting
hours
is
a day.
they're usually in areas that are pretty low cost of living because they're the middle between two big um, cities. Like we stopped in, I think, Athens, Alabama, coming home from a baseball tournament at the Rodent's Nest, I call. Yeah, I know beavers aren't rodents, but that's just what I call them. But just real quick example, since our wives never listen to this, by the way. This is why I don't like Buc-ee's. Okay, I'm gonna just put it out there. In this, we might lose. You might hit some unsubscribes, right? We're walking around like idiots. I'm not. I'd refuse to get any food there because I know it's overpriced and they give you too much. And my wife and daughter throw things in the basket. Well, that's our lunch for tomorrow. Okay, I didn't get anything. What happens on the drive home? I ended up with I had chicken fingers and some leftover because everyone else gets overserved. And I'm like, why do I want to order a meal when I know I'm going to get leftover? I'm happy with what they order. But here's the bugaboo, John. So if I would have ordered a meal for myself, I would have just wasted money. Oh, and if my wife, I might have to, you're going to have to remind me when this comes out because I'm going to make sure that she listens to this. Guess what's sitting in my refrigerator right now?
Oh, some leftovers.
No, the lunch they had to have for today that they bought yesterday. So I can't wait till they get home. I can't wait to open that refrigerator up and show them the overpriced lunch that they had to have.
Although on the flip side, then we will wrap this up, and we promise, when me and you go into Buc-ee's, we treat it like a speedway. We fuel up, we go in, grab maybe something, use the restroom, we're out. It's like a 6-minute excursion.
We're a machine, baby. We are a machine.
You got it. You
Just
got
like
it.
you need to be a machine when you do tax planning. Hey, I'm happy to do these episodes for our lower to middle, moderate income households, in all seriousness. It's not all about high income, high asset level taxpayers. So hopefully they had an opportunity to listen to this and maybe do a little planning and make sure they take advantage of the savers credit.
Yeah, absolutely. And as Chris mentioned a little bit earlier on this too, if you didn't catch that, I'll say it again. Check out our private Facebook group. That's defeatingtaxes.com. We'll put that in the show notes here as well too. Direct link. Over 2,100 people, I believe, in there. A lot of them actually are tax pros. And here's a good little tip for anybody. If you do have a question that you say you don't feel comfortable or don't have somebody to ask, you can post it in there publicly, or you can post it anonymously. Surprisingly, even a lot of the anonymous posts that get in there get a lot of traction. They get a lot of good answers. So don't feel that you have to put all your business out there. Everybody's going to know it. They're going to click on your profile. They're going to see where you live, your family pictures, all this stuff. Post it anonymously if you have to. Literally, that community is built to help people that are part of it. So as we continue this journey of teaching tax flow, we'll see if we'll be back here again next week on the podcast. Different time, same day of the week, completely different topic. See everybody very soon. Have a great week.
The content provided is for educational purposes only. We encourage you to seek personalized investment advice from your financial professional. For all tax and legal advice, please consult your CPA or attorney. Investment advisory services are offered through Cabin Advisors, a registered investment advisor. Securities are offered through Cabin Securities, a registered broker-dealer. The content of this podcast does not constitute an offer of securities. Offerings can only be made through an offering memorandum, and you should carefully examine the risk factors and other information contained in the memorandum.